Thank you for joining us. My name is Jeff Hybiak. I'm the Senior Portfolio Manager from SEM Wealth Management. Before I get started, we're going to try to keep the entire presentation right around 30 minutes. I know a lot of you are at lunch or just taking a break from work, and we want to respect your time. We do want to leave time for some questions at the end. So there is, if you mouse over the button, there's a Q&A box. So feel free to ask your questions at any time. And if we happen to have so many questions, we'll still let you know at 12:30 when we're done. We'll try to get to as many as possible. So with that being said, I'm so thankful that so many of you decided to join us today. You know, you think about where we were at a year ago, and I was in our Tucson office as our country just began to panic. It was, apparently, this is the one-year anniversary of when it was declared a pandemic. I remember it because I was sitting at Cody's house on the couch watching an NBA game, and literally they shut down the NBA season right there as we watched. And I was supposed to go back home to Virginia in a couple of days, and I was wondering if I'd be able to even catch a flight home, or if I'd have to rent a car. Well, obviously I'm back here in Virginia, so I made it home. That was my last airplane trip. And I'm somebody who used to travel all the time, way too much. And, you know, I have not been on an airplane since. And so now as we emerge a year later, I think even the most pessimistic person can't help but feel a little bit of excitement. And, you know, what's next? We're finally getting out of this. What's going to happen? But I think it's important for us, especially from an investment standpoint, to not let that excitement, those overwhelming feelings of joy, to influence how we're deciding what to do with our money. So that's one thing we're going to talk about today. And let's look at it. One thing's important with SEM. Those of you who have known us a long time, we focus on the data. I'm looking at data just all day long. All of our team is. And we want to use that data to make decisions. And here's some of the things that I think are going to be important for us to watch as we go throughout the year. First off is we have to keep things in perspective and realize this was a significant setback to our economy. There was severe damage done. Here's the chart of GDP, and you can see what a big hit it took. We're way back, and we've given back several years worth of economic growth, and we're down still 2% from the high. Even you can kind of see the impact of the shutdown and then the rally back, and then it's kind of tapered off as far as the comeback has gone. And how this develops is going to be important. Wall Street is pricing in a full recovery by the end of 2021, which would be great. It would be wonderful to say our economy is producing the same as it was at the end of 2019 today. If that doesn't happen, we could see a big setback in stocks. We could see them lose some of the gains that they've been enjoying because everybody's pricing in a much better economic environment. And if that doesn't happen, we got to be careful. So this is one chart I'm going to be watching. The other thing I think we have to keep in mind is this diagram that I made over the summer is, you know, what I labeled the K-shaped economy. And you have to realize, even though we're only down 2%, we have to be careful to understand that not everybody had the same experience in 2020, or even really over the last 4 years that we had. You know, if you're on this call, most likely you're in the upper part of the K. And I'm not defining it by class. I'm just defining it as if you didn't feel a loss of income in 2020, if you made the same or maybe even more in 2020, if you were able to take your job and shift to work from home or have some sort of modified structure, or you just kept your job because you were essential, you're in that upper part of the K. And the danger we have, and we're going to talk a little bit about this at the end, is if you think of the structure of a K, is we have a full economy. And if we lose that bottom half, if it gets weak, the top part of the K is also going to tumble. And so that is something very critical. We can't have a very divided economy. We have to have everything sort of working together. So the trick in 2021 will be, how can we strengthen the lower part of the K, those people who were impacted the most from COVID, at the same time without, of course, bringing down the top part of the K, because they're the ones who kept the economy running. We were only down 2% because we did have some very strong economic numbers in certain segments of our economy. That's why the stock market has been able to go up so much. So this will be that tug of war that we're going to be looking at throughout the year. Now, the lower part of the K, those people who lost their jobs, really shows up when you look at the payroll numbers. And one thing that I think is even more alarming when you look at this is it doesn't include the number of hours worked per job. That's gone down a lot. The average wages per job has also gone down. If you worked 5 hours, that's counted as a job. So we have a severe recession, almost depression in the labor market. So this is a chart that I'm going to be watching very closely, because those who lost their job, that's literally the lower half of the K. And we need to see this come back at a rate that justifies what we're seeing in the stock prices. Otherwise, this economic growth we're seeing is just going to be temporary, and we're going to be looking at a recession again in 2022 or maybe 2023. Now, the other thing that I think is important is consumer sentiment. I thought that we would have already seen a big spike in consumer sentiment as we got the vaccines coming out and some states are opening up. And I really thought that last month we would have seen a spike, and it simply hasn't happened. And this is going to be really critical as far as how much depth we have to the economic recovery, because a confident consumer spends money, a not confident consumer saves money. And so far the surveys are showing, and not that this is a bad thing, as a financial advisor, let me tell you, when you get your stimulus check, this will be the third stimulus check, or I guess electronic deposit into your checking account, what we're calling around here the Biden bucks. When they arrive, as your financial advisor, I would say if you have debt, pay it down. If you lost some of your emergency funds during 2020, pay, refund, put money back into that account. If you don't have a new car fund, a next car fund, I should say, start it. Don't just waste this money, because we don't know what the next 3 to 4 years is going to look like. We don't know your tax situation, everything. Save it. Now that's me talking to you as a financial advisor. As an economist, we want you to spend all that money 100%, maybe even go into debt, because economists want you out there spending money, stimulating the economy. But for your personal situation, that's probably not the best thing you can do, because as I said, the chances are this is a very temporary boost to the economy, which means we're going to be looking at some more economic problems in the next year or two. So we'll be watching this. Overall, as a country, are we getting more confident? If they're spending money, great. Maybe this economic recovery can go even longer and higher than we thought. If this number stays low, then we're going to probably see much worse growth than people expect. And the market's probably going to adjust accordingly. Now, I think everybody here believes 2021 is going to be spectacular. I spend a lot of time listening to calls like this, but from Wall Street analysts. I read all their research reports, and to a person, they all think 2021 is going to be spectacular. It always makes me worry when everybody thinks that the sky is the limit. I have to ask, what could go wrong? And I think there's plenty of things that could go wrong, and I'm not seeing these addressed in any of the research reports. And I think it's something that we as investors need to understand, that there are definitely big risks, and these risks could cause significant losses to investment portfolios. The first thing I'm seeing is inflation. It's becoming a much bigger problem than most people are realizing. And it's showing up first in manufacturer prices. So the prices that manufacturers are paying for the things that they need, their raw materials, are going up significantly. It's the highest spike we've seen since 2008. And this was at that spike was during the beginning of the financial crisis. So this will likely, the last half of the year, filter down to consumer prices. And so this inflation can really hurt and cause a drag on the economic recovery, because your money's going to not be able to buy as much if we see runaway inflation. I'm just going to take a detour here, though, because I am seeing a lot of misinformation out there, or maybe I should just say misunderstanding of how the economy works. And so depending on your political leanings or what your feed looks like on social media, you may have heard that President Biden is solely responsible for the increase in gasoline prices. And I have been armed with this chart that I created off the Federal Reserve database. Now, I added the coloring and I added the arrows. I wanted to show people that gas prices go up or down regardless of which party is in control of the presidency. Some people would say President Obama was anti-oil. Well, prices from the time he took office to the time he left barely changed. We did have a spike in the middle years, but they came back down. President Bush, George W. Bush, was supposed to be pro-oil, and we saw prices go up almost his entire presidency until one critical thing happened. It was a recession. Notice those red arrows. Prices go down during a recession. Notice what happens right after the recession. Prices go up a lot. That keeps happening. Gasoline prices are based on expected demand. People are expecting huge demand as we go into the summer months. They are expecting everybody to be driving and taking vacations and just spending a lot of money, which has led speculators as well as the gasoline sellers to try to hedge against that. So they've driven the price up in the futures market. That's all. None of President Biden's ideas have even been entered into the market. It could be years before those enter, and maybe they cause oil prices to go up. Maybe they cause them to go down. The number one determinant of gasoline prices is which direction do we think the economy is going. That slowdown we saw under President Trump was not due to any of his policies. It's because people were anticipating a recession even before COVID happened. Remember, our economic model in the spring of 2019 was saying economic growth is slowing down. At the same time, gasoline prices came down. That's no coincidence. Not a political statement. That's just me wanting you to be armed with the data that, you know what, gas goes up with the economy, it goes down with the economy. So back to the topic at hand. Let's look now as we shift gears to what the Federal Reserve is doing, because that's the other pillar that we're seeing as far as the ability for the market to rally in 2021. The first is the stimulus. The second is the Federal Reserve. A lot of people are banking it on, what's the Federal Reserve, going to do? They believe they're going to be able to save everything. And this is my favorite chart that I use. It's very complicated, but it tells us what the Fed is doing with their money. So the blue line is the Federal Reserve balance sheet. A lot of you have probably heard of quantitative easing. I've heard it been called money printing. Whatever you want to call it, this is the Fed electronically creating money so that they can turn around and buy assets from the marketplace, the Wall Street banks. And so what they've been doing during this crisis is creating more money and then buying Treasury Bonds and a little bit of mortgage-backed securities. And then the banks turn around that purple line and use reserve balances. But let's zero in specifically on this green line, which is Treasury securities. Now, since the crisis started in a year ago, the US government has had to borrow $3 trillion in Treasury bonds. So they've issued $3 trillion. During that same time frame, the Federal Reserve has purchased $1 trillion. So the Fed has funded 1/3 of our $3 trillion of borrowing in the last year. Now, what just happened yesterday? The US government, which was already running a $1 trillion deficit for 2021, just voted to add another $2 trillion to that deficit. So we're going to have to borrow at least another $3 trillion the rest of the year. The question will be, is the Federal Reserve going to be able to continue funding 1/3 of the US government? I think the bigger question is going to be, will the Federal Reserve have to fund more than 1/3 of the US borrowing? Because we're starting to see something in the interest rate market that is going to be a big concern, I think, for every American, every investor out there, which is interest rates cannot stay low forever. This is something that I think we all need to understand is The Federal Reserve controls short-term interest rates. They cannot, however, control long-term interest rates. The free market controls long-term interest rates, especially the 10-year Treasury interest rates. So that's the battle that we're having. And this long-term chart shows that the trend line going down of interest rates is at risk of being broken to the upside. It hasn't quite broken it yet. And we do see that it did happen in 2018 and 19. And this was after the Trump tax cuts. People were concerned about our deficit. They were concerned that inflation was going to be a problem. So we saw interest rates going up. So I think the critical question for 2021 and what's going to happen in the markets is what happens with long-term interest rates. And this is going to be important because I don't know how much the Federal Reserve is going to keep being able to borrow if rates keep going up. And so we're going to watch that very closely. Now, let's go back to our K-shaped economy and let's just use some simple logic here. Is we know the bottom half of the K is hurting the most. We also know as the economy grows, we're seeing gasoline going up, we're seeing the prices of goods and services going up, and housing, even at the beginning of the crisis, just started taking off, and it's continuing to go up and up and up. And I don't know if any of you have tried to look at rentals. It's not just new and existing home prices that are going through the roof across the country. It's rentals, apartments. Our daughter Courtney was just moved out here to Virginia and looking at apartments. I cannot believe how much just in a year and a half since we were renting that prices have gone up in our area. Any area I've talked to people, housing prices is hurting. And then you look at what's happening with interest rates. And typically people, lower half of the K have more debt, credit cards, things like that. Their interest rates are going up because those are based on not what the Federal Reserve is doing, but they're based on 10-year Treasury rates. So the people who are at most risk in our economy, the people that need to be helped, are actually being hurt by the policies they're trying to put into place to help people. So all this money being dumped on the economy is actually causing the bottom half of the economy to be hurt more, because when you're living paycheck to paycheck, you can't afford for gasoline to go up, or for the prices of all the goods and services that you're purchasing to go up, or for interest rates to go up. You can't afford to move. And if your lease renews at a higher rate, what are you going to do? It's something that I think is very important, and it's something that can weigh on job growth, because if that starts happening, we could see those jobs not come back at the rate that we need to see them happening. So we have to keep that in mind. So that being said, there are opportunities that, we're an investment manager. We have to invest whether we're in a great economy or a terrible economy. And if you're listening to this call and you're not an SEM client, I want to give you a few things that we're looking at here internally as ideas of ways that we can make money here in the next year. And the first place, let's talk about bonds. And we talked about Treasury bonds. What we didn't talk about, and I think it's really important to understand this, not all bonds are created equal. A Treasury bond is thought to be low risk in the sense of you don't expect the US government to default on its debt. You expect to get your money back. But there's other corporate bonds out there. In particular, we like to use high yield bonds selectively to not only make a nice yield, but also to have some capital gains as the economy gets better. And if you look at the chart of yields, the blue line is the yield on the high yield bond index, also called junk bonds. And the red line is the Treasury bond yield that we've seen. And what's interesting is, even though high yield bond yields are at their lowest yield ever, right around 4.5%, they are still somewhat attractive when you compare that to Treasury bonds. But there's a big caveat with that. And that is, if the economy is doing well, maybe it makes sense to have a high yield bond at 4% interest. But if the economy does not do well, if interest rates on the 10-year Treasury keep going up, if inflation starts to be a problem, guess what? We're going to have defaults. Then we're going to see not only loss of principal, you're going to see the yield spike, because things are now more risky with high yield. So There are opportunities, but you have to be very selective and you have to be very cautious. And that's something that, is our specialty. We've been doing that since 1992 here at SEM. And it's something that is kind of our bread and butter of most portfolios out there. Now, the other thing, let's talk about Treasury bonds. Is Treasury bonds are not low risk investments in terms of how much money can you lose on a daily, monthly, quarterly, yearly basis, because every move in Treasury bonds interest causes a big move in the principal value. And each dot on this chart shows what would happen for each subsequent change in interest rates. So one thing to keep in mind, if interest rates go up, your bond goes down in value. If the interest rates go down, your bond goes up in value. So you could see there's some big losses there. So what I've heard a lot of Wall Street analysts telling people to do is, why don't you use dividend stocks as an alternative to bonds? But what they're not telling you is the risk that you're taking going to that. So just in 2020, in 3 months, we saw dividend stocks lose between 25 and 33%. Look at this chart here. Even if interest rates doubled on a Treasury bond, you're only going to lose 12%. That's important to understand, is you can lose significant amounts of money in dividend stocks, and they're only yielding between 1.8 to 2.3%. That's not very attractive. We have to understand with dividend stocks, they're not guaranteed. At least if you have a Treasury bond, you're going to be getting income and you know the government's going to keep paying you. What happens in a recession? The dividend paying companies tend to cut their dividend. It does not provide that buffer during a recession. So we have to keep that in mind if you're an income investor. You have to be selective. You have to pick your spots, and you have to be able to think differently. Now, let's move it to the stock market. Growth stocks have been doing well. I talked to one of our advisors who started in 2011, and he said, you know what? Growth has always outperformed value my entire career. And he's right. So there's a lot of you that probably think large cap growth stocks in your 401k or your TSP are the best place to be. That's the only place to be. And that's been true for going on 11, 12 years now. But that's not always going to be the case. Here's a chart of the last 5 years. Growth stocks have done well. They've just trounced value stocks. And we're hearing again, value investing is dead. Warren Buffett's washed up again. And to me, it's very reminiscent of when I started my career at SEM in the late 90s, of we were hearing these same things. And one thing that me being more of a value type investor who likes numbers and data, I just could not mathematically justify the prices you're paying for growth stocks. And the same is true today. Some of these growth companies will never be able to pay you back in earnings growth for what you're paying for them today. And I'm not going to name specific companies, but in general, large cap growth is extremely overvalued, which means your chances of losses are much higher. Value stocks, on the other hand, if you look back at the year 2000 to the end of 2007, they had a great run. They trounced growth stocks. I don't know when this will happen, but this will happen again. You have to be careful to not be too overweight growth and not have any value in your portfolio. You have to be looking at, maybe we should take chips off the table in growth and look at value. And if you're doing this on your own, that's something I would definitely be looking at. I don't know the timing, but math tells us that this rebalance and reversion back to the mean where value has a strong run will happen. And we can't forget that it has happened before, even in the last 20 years. The way we do it at SEM is we run everything through a filter. We have AmeriGuard and we have Cornerstone, and we look at all these different factors, and I'm not going to go into each one of those. If you want to talk about your specific investment models with SEM, let me know, let your advisor know, we can go into them. We have been trimming our large cap growth positions since last October, and it's likely we're going to continue doing so. So we do this based on mathematics and our models, not based on our feelings about the market or about what's going to happen. From a bigger picture standpoint, I think this is why you follow a behavioral approach. I'm a long-term believer in the growth of the market, but it's only going to grow long-term at the rate of economic growth plus dividend yields plus inflation. You get times where we're way overvalued and everybody's too optimistic. we're probably here or here. I don't know where we're at in the cycle. You're better off investing when we're down at the bottom. That's simple math. That's how the markets have worked for over 100 years. You wait till things are more attractive, then you can get excited. If you're buying and holding starting today, your chances of really great returns are much lower than if you wait for a better opportunity, and that's what we're doing at SEM. The way we do it, I think our behavioral approach is extremely valuable. It proved valuable all throughout 2020. Is we work with financial advisors on your financial plan and your cash flow strategy. That becomes the foundation of everything that we do. They then work with SEM, where we help them divide their assets up into different layers. We select the investments, and we even have room for riskier investments. We have a lot of ways that we can still get you those exciting returns. But the important part is it has to work with the rest of your plan and the rest of your portfolio. And finally, I'm not going to go into each model, but this is an illustration of all the different options we have. We can customize a portfolio for pretty much every investor out there around their financial plan and cash flow strategy. And each one serves a different role in your portfolio. And it served us very well over the last year and really going back to inception when we started in 1992. So finally, if you are not sure of where you should be, if you just want some sort of a sense of, hey, what type of investor am I encourage you to go to semwealth.com, check out the Risk Questionnaire, and take it. It's 10 simple questions. You'll get some information about who you are as an investor. If you're a client of ours, we can review your portfolio and see how everything lines up. And then we'll leave it with, use the blog. If you're curious about what's happening, what we're seeing in the markets, the blog is there. I post something at least every Monday. If you're into technology stuff, Dustin writes a tech blog that, he just posted something this week about one of the breaches that Microsoft had. So check us out. There's subscribe buttons for each of those. And with that, I'm going to see what questions we have. As a reminder, use that Q&A box, and we will go from there. So let me stop sharing that and see what we got for questions. So this is a good one, and I could do a whole webinar on this, is what will be the outcome of the additional $2 to $3 trillion deficit? We don't know yet. From a math standpoint and what we've seen, survey-wise and everything else, I think it's safe to say that of this new stimulus, half of it's basically thrown away. And what I mean by that is there's different kinds of government deficits that can be run. A good deficit is if that money is going to go into things that are going to produce future economic growth, such as an infrastructure program that makes people so they can travel more efficiently. We can get goods and transported more efficiently. That pays back again and again and again. Think of it like you're a business owner. You want to invest in things that provide future growth, future earnings. The other half, when you put money into things that get spent, it's gone, especially when we're running such a large trade imbalance. Because if you go to Walmart, yes, they're paying some workers in the US, but almost all of the things they purchased came from overseas. So you're essentially taking US taxpayer money and you're giving somebody some money to spend, but then that money's gone. It doesn't keep reproducing in the US. So I think half of it's going to be gone. I think like I said, the question is going to be, how much is the bond market going to be able to absorb? Will the Federal Reserve be able to keep interest rates lower by continuing to purchase those bonds? I don't know. I think long term, and I've said this really for 20 years, we should all assume taxes are going to be higher. When you spend money now with a deficit, you've essentially taken money from the future and you've pulled it back to the present. So you're borrowing it. It's the same way if you use a credit card to fund your family budget, as you have to pay that credit card back, you have less money. So if you have less income in the future, it's not going to matter. Now, all that said, that bottom part of the K, that is technically an investment. because there's all kinds of studies that have been done, and the longer you're unemployed, the longer you're in poverty, the more it turns into a long-term drain on your whole economy. And so this bill, this is not a political statement. It was a typical Washington job of, we had a crisis, and then everybody started throwing in their pet ideas. Thankfully, some of them got tossed back out, but instead of targeting that lower part of the K, they're just throwing a whole bunch of money at a whole lot of things. And unfortunately, like I said, at least half of it's going to be wasted. It's not going to lead to future economic growth. So it is 12:30, and let's see, we got one more question. I'll try to do this quick. Would a more split Congress have had a different result? I mean, obviously, if Republicans controlled Congress, we kind of saw that, flipped around, where, during the crisis, we had to have the Democrats side with President Trump and the Republican Senate. So for the most part, the first stimulus bill was pretty good. There were some rules in the PPP loans that were, a lot of people took advantage of that probably shouldn't have gotten money. But for the most part, it was well done because, yes, a split Congress fixed that. They only were able to do things both sides agreed on. And then, keep in mind, though, President Trump, before he left office, was pushing for even bigger stimulus checks and more people to get stimulus checks. So I don't know what it would have looked like now. I think it is safe to say we would have had a more targeted stimulus. But we can't go backwards. I mean, it is what it is. My hope is the same hope that I have every 2 years, is that if your side didn't win, you find candidates who appeal more to the American people. And I had to take the chart out for the interest of time today. But one thing that we have to keep in mind is there are more registered independents than Republicans or Democrats by themselves. So the independents are the ones who elected Democrats to the Senate, and they elected Joe Biden. Their votes swung the race. So independents who supported Donald Trump in 2016 swung over to Joe Biden in 2020. Same way in the close races for Congress. So I don't think it's as polarized as we think, because the independents are still calling the shots. Right now, independents, the last numbers I saw, have a 60% approval rating for Joe Biden. Their approval of Donald Trump when he left office was 40%. But in 2 years, that can swing back the other way. So if things happen the way I predict, is the party in charge will be blamed for the economy, or they'll get credit for the economy. And my prediction is, just like the Trump tax cuts, it's going to be a short-term pop to the market. And then because we didn't invest in the future, it's going to be gone. And then we're going to be stuck with money we have to pay back. The timing of that could be right into the midterm elections. So, I kind of predict the Democrats, will lose control of the House and or, even Senate, or both in 2022. So I'm just a couple minutes over time. We're going to go ahead and cut it off, and so everybody can get back to their day. Hopefully, depending on where you're at, here in Virginia, it is a gorgeous spring day. It's been a while. Get outside and enjoy the rest of your day. And just keep in mind, at SEM, we're here worrying about all the things, the difficult stuff, using the data, using our models, so that you can go about and focus on things that are important to you. And hopefully, if you're a client or an advisor of ours, you felt that sense of calm over the past year. If you're not a client or advisor of ours, or if you have friends who aren't clients or advisors of ours, I'd love to talk to them, because there is a better way, and it's going to be difficult, but I'm excited about the future. I'm excited about the opportunities that we're seeing. So thank you for all your time. Stay tuned, subscribe to the blog. We're going to continue posting things, and we'll, again, try to do some of these updates as frequently as necessary. So thank you.